Hi everyone, welcome back to episode 3 Financial Statement. To get to know more about financial statement, first we need to know the objective. The objective of financial statement is to prepare a statement of financial position and statement of profit or loss and other comprehensive income from given information. Also, we need to understand, identify, and report reserve in a company statement of financial position. Moreover, we also need to identify items requiring separate disclosure on the face of the statement of profit or loss, explain the purpose of disclosure note, and last but not least, define and classify events after the reporting period as either adjusting or non-adjusting events. According to IAS 1, presentation of financial statement, the required format for public company financial statements are provided by IAS 1. This requires some component to be presented. There are 5 parts. The first, statement of financial position. Second, statement of profit or loss, or statement of other comprehensive income. The third, statement of change in equity. The fourth, note to the financial statement. Last but not least is statement of cash flows. What is statement of financial position? Statement of financial position summarize the asset, liability, and equity balance at the end of the accounting period. Regarding IAS 1, they require that asset and liability must be classified as either current or non-current in the statement of financial position. You can see in the equation asset equal liability plus equity. The suggested statement of financial position format make a distinction between current and non-current assets and liabilities. Regarding IAS 1 sets down the rule to be applied in making this distinction. For current assets, an asset should be classified as a current asset if it is held primarily for trading purpose, expected to be realized within 12 months of the statement of financial position date, or cash or a cash equivalent, for example, a short-term investment such as a 30-day bond. All other assets should be classified as non-current assets. This definition allows inventory or receivable to qualify as current assets, even if they may not be realized into cash within 12 months. Assets under or above, even if they may not be realized into cash within. For current liabilities, the rules for current liabilities are similar to those for current assets. A liability should be classified as a current liability if it's expected to be settled in the normal course or the enterprise operation cycle. It held primarily for the purpose of being traded. It's due to be settled within 12 months of the statement of financial position date, or the company does not have an unconditional right to defer settlement for at least 12 months after the statement of financial position date. All other liabilities should be classified as non-current liabilities. Moving to statement of profit or loss. Statement of profit or loss summarizes the income earned and expense incurred during the financial period. For statement of other comprehensive income, this is simply an extension of the statement of profit or loss. The reason for this is that some gains made by the entity during the year are not realized gains. The best example of this is the evaluation of tangible non-current assets. The gain is not realized until the asset is sold and converted into cash. The revaluation represents a hypothetical gain. For example, what gain would be made if the asset was sold at the date of the revaluation? For these reasons, it should not be included in net profit for the period, which represents for the profit earned from realized sales. Instead, the unrealized gains are added on to the end of the statement of profit or loss. An entity can choose to present the two separate statements as below: the statement of profit or loss for the year and statement of other comprehensive income for the year. Items requiring separate disclosure. Certain items need to be separately disclosed on the face of the statement of profit or loss, or else disclosed in the note to the financial statements, so that they are clearly visible to the user of the financial statements. The main items requiring such treatment are significant. One of transactions or events. They need to be disclosed because they are not part of the normal trading activity of the business and could significantly distort the reported profit or loss for the years. They include costs of restructuring or reorganization of the company, profits or losses on disposal of property, plant and equity, or we can say investment, and impairments of inventory, property, plant and equity. All such items should be included on its own separate line in the statement of profit or loss. Here is the relationship between the statement of profit or loss and statement of financial positions. Statement of change in equity. Equity represents the owner's interest in the company. An alternative way of defining it is that it represents what is left in the company when it ceases to trade, or the assets are sold off and all the liabilities are paid. Any surplus remaining can then be distributed to the equity holders or ordinary shareholder. Equity comprises share capital, share premium, and reserve. The main reserve are the revaluation surplus or retained earnings. For revaluation surplus is created to recognize the surplus arising when tangible non-current assets, normally land and buildings, are revalued. The gain is not realized, so cannot be included in the retained earnings of the entity. However, the gain would still form part of the value repaid to the equity holders if the company was to be sold off at the point in time. Retained earnings represent the sum of total of all the profits and losses made by the company since its incorporation and that have not yet been paid to shareholders as a dividend. As these elements are particularly relevant to shareholders, it is important to ensure the shareholders understand any movement in these balances. For this reason, a statement of change in equity is required. It summarizes the opening and closing positions on all equity accounts and identify the reason for any movement during the year. Disclosure notes are required for a variety of reasons, such as to explain the accounting policies used when preparing the accounts, to explain the movement between the opening and closing balance of major statement of financial position items, to show how certain balances are compiled, and to provide further detailed explanation to user of the financial statements as necessary for the account to be understandable to the user. Statement of cash flow. A statement of cash flows is needed as a consequence of the differences between profit and cash. As explained earlier, it has two axes: liquidity and solvency. An adequate cash position is essential in the short term, both to ensure the survival of the entity and to enable debt and dividend to be paid. Financial adaptability. Will the entity be able to take effective actions to alter its cash flow in response to any unexpected events? Future cash flow. An adequate cash position in the longer term is essential to enable asset replacement, repayment of debt, and fund further expansion. Cash flow means survival. An entity may be profitable, but if it doesn't have an adequate cash position, it may not be able to pay its debts, purchase goods for resale, pay its employee, etc. The statement of cash flow also highlights how cash is being generated. For example, either from operating, financing, or investing activity. An entity must be self-sufficient in the long term. In other words, it must generate operating cash inflows, or it will be reliant on the sale of assets or further finance to keep it afloat. Cash flow are also objective. They are matter of fact, whereas the calculation of profit is subjective and possible to manipulate. Thank you everyone for watching from the